Stop for a moment and remove everything you think you know about price charts, technical indicators, and bullish narratives, because none of them explain what is happening right now. Something far more serious has already occurred beneath the surface of the silver market, and almost nobody is talking about it in plain language. The move in price is not the event. The headlines are not the event. The celebration is not the event. The event already happened quietly inside the mechanics of the market itself. Markets do not fail loudly at first. They fail softly in places most people never look. They fail in delivery notices, in settlement behavior, in curve distortions, and in decisions made by participants who have no incentive to explain themselves publicly. Those participants do not speak on television. They do not post on social media. They act, and their actions leave fingerprints in the data. Right now, silver is covered in those fingerprints. What most people see is silver trading near historic highs and assume this is just another bullish phase, another speculative rally fueled by inflation fears, currency weakness, or momentum casing. That interpretation is comforting because it suggests the system is still functioning normally. It suggests price is simply doing what price has always done. But comfort is exactly what disappears when a system begins to fracture. The real story is not that silver moved higher. The real story is that time itself stopped behaving normally inside the silver futures market. Contracts that should have rolled forward into the future instead rushed backward into immediate delivery. This is not a technical curiosity. This is not an academic nuance. This is survival behavior. In a healthy futures market, time is your ally. Futures exist so that participants can gain exposure without touching the underlying asset. Delivery is something traders avoid because it is expensive, inconvenient, and unnecessary. Rolling forward is the default behavior because the future is assumed to be safe. That assumption is the foundation of the paper market. When that assumption breaks, everything breaks with it. Recently, a large number of silver contracts did something extraordinary. They did not migrate toward later months, where liquidity is deeper and conditions are calmer. They moved aggressively toward immediate settlement. This means participants willingly accepted higher costs, logistical complexity, and operational friction simply to secure metal now instead of later. That decision makes no sense unless waiting itself has become a risk. This is the first rule you must understand. No rational, sophisticated participant chooses inconvenience unless convenience has become dangerous. This was not retail behavior. This was not emotion. This was not hype. These were disciplined entities making a calculated choice to abandon time in exchange for certainty. And that choice tells you more about the condition of the market than any chart ever could. The futures market is built on trust. Trust that delivery will be possible later. Trust that paper can always be exchanged for physical when needed. Trust that inventory exists somewhere, even if it is not immediately visible. When that trust is intact, paper trades freely and delivery demand remains minimal. When that trust weakens, paper becomes suspect. What we are witnessing is not a bullish frenzy. It is a quiet vote of no confidence. The price moving higher is not the cause of this behavior. It is the consequence. Price always moves last. Behavior moves first. Structure breaks before headlines appear. By the time the public notices price, professionals have already repositioned. This is why focusing on the number is a mistake. Whether silver is at 70, 80D, or 90 is secondary to the question that now dominates the market. Will metal promised later actually be available later? Once that question enters the system, behavior changes instantly. Waiting stops being rewarded. Time stops being neutral. Time becomes a liability. This is why backward rolling is so dangerous. Backward rolling is not a trade. It is a warning. It signals that participants believe the future is less reliable than the present. That belief alone is enough to destabilize a leverage system. The paper-silver market functions only because most participants never show up for the metal. The ratio of paper claims to physical inventory is manageable only under that assumption. If even a small percentage of participants decide they want the actual product, the math breaks quickly. This is not theory. This is arithmetic. Silver is not just an investment vehicle, it is an industrial input. Solar panels, electronics, medical equipment, and defense technologies depend on it. Industrial users do not speculate, they secure supply. And when supply feels uncertain, they do not wait for better prices, they pay for certainty. This is the most misunderstood aspect of commodity crisis. People assume demand disappears when prices rise. That is true for discretionary demand. It is not true for essential demand. Industrial buyers will overpay before they shut down operations. That behavior turns tight markets into violent ones. Now consider what happens when industrial logic enters a futures market designed for financial speculation. The rules change, elegance disappears, efficiency becomes irrelevant. Access becomes everything. This is why delivery behavior matters more than open interest headlines. This is why curve shape matters more than RSI readings. The curve is the lie detector. It reveals what participants are willing to sacrifice, and recently participants sacrificed time. Time is normally valuable in futures markets. Time gives flexibility. Time gives exit options. Time allows for optimization. But suddenly, Time became something participants were desperate to reduce. They paid premiums to do it. They accepted chaos to do it. That tells you all you need to know about confidence. When time becomes a threat, the system reprices violently. This is also why banks are far more concerned than they appear. Rising prices can be managed with paper. Delivery preference cannot. Delivery requires inventory. Inventory cannot be printed. Inventory cannot be conjured with accounting entries. When delivery demand rises, the illusion that paper equals metal begins to crack, and once cracked, it does not heal quietly. The most dangerous part of this phase is that it is invisible to the public. The public watches price and assumes price explains behavior. Professionals watch behavior and understand price will follow. This is how every structural failure begins, quietly. Inside the plumbing, by the time it becomes loud, it is already irreversible. The silver market is now in a phase where trust is being tested in real time. Every delivery notice is a vote. Every backward roll is a signal. Every distortion in the curve is a message. And the message is simple. Possession is being valued over promises. Once that shift occurs, the paper market enters a countdown. The future stops being an abstract concept and starts becoming a deadline. Contracts are no longer exposures. They are obligations. This is where fear replaces optimism as the driving force. Fear of absence is far more powerful than excitement about gains. Fear compresses time horizons. Fear creates urgency. Fear creates vertical price behavior. This is how triple-digit silver is born, not through hype, not through retail mania, through structural stress and delivery demand. Most people will not understand this until it is obvious. By then, the easy window will be closed. This is not because information was hidden, but because attention was misplaced. Markets always warn before they break. The warning is simply delivered in a language most people do not speak. Backward rolling was that language. And it has already spoken. Once trust begins to weaken inside a futures market, it does not erode evenly. It concentrates stress in specific places first, and those places are always the same. The front months feel it before the back months. Delivery mechanics feel it before price charts. Spreads feel it before headlines. What you are watching now in silver is not chaos. It is order revealing itself under pressure. The most important mistake people make at this stage is assuming that if something were truly wrong, it would already be obvious. That belief is comforting, but is also how systems fail quietly. Obviousness is always late. Structural signals arrive long before emotional reactions do. Think about how confidence actually works in markets. Confidence is not a statement, it is a behavior. It is revealed through what participants choose to do when they are not required to explain themselves. When people trust a system, they behave lazily. They optimize for convenience. They roll forward. They defer decisions. They assume tomorrow will look like today. When confidence breaks, laziness disappears instantly. Optimization gives way to urgency. Participants stop asking what is cheapest and start asking what is safest. That transition is exactly what backward rolling represents. Backward rolling is a rejection of delay. It is the market saying that the future is no longer a neutral place to park exposure. And when enough participants arrive at that conclusion independently, their actions begin to reinforce one another. This is how feedback loops are born. One participant rolling backward could be dismissed as idiosyncratic. 10 participants doing it becomes interesting. Thousands doing it becomes systemic. At that point, the action itself becomes information. Other participants see it, model it, and respond to it. Fear does not require proof. It requires probability. This is why the phrase, "What if" is more powerful than any data point. What if delivery becomes difficult? What if vault inventory is tighter than advertised? What if others move before we do? What if waiting costs us access? Those questions do not need definitive answers to change behavior. They only need to feel plausible. Now consider the role of open interest during this phase. Most people misunderstand open interest completely. They see it rise and assume bullishness. They see it fall and assume profit-taking. But open interest is not directional, it is descriptive. It tells you where obligations are sitting. When open interest drains from a future month and reappears in a nearer month, that is not money leaving the market. That is money relocating within the market. It is capital choosing proximity over patience. That choice is critical. Capital does not voluntarily move into less liquid, more chaotic environments unless it perceives safety elsewhere has deteriorated. Liquidity is normally protection. Participants abandon it only when protection feels illusory. This is why dead months suddenly matter. Months that are usually ignored become focal points when time preference collapses. Illiquidity is tolerated because immediacy becomes priceless. That is not a normal optimization. That is crisis logic. Crisis logic does not care about elegance. It cares about survival. This is also why the futures curve becomes the most honest document in the market. Narratives can be spun. Prices can be explained away. Curves cannot lie. They aggregate decisions made under pressure. In calm conditions, curves slope gently upward. The future is priced higher than the present because storage, insurance, and financing cost money. That shape reflects abundance. It reflects trust. It reflects time comfort. When that shape inverts, something fundamental has changed. The market is saying the value of having silver now exceeds the cost of carrying it. That only happens when immediacy itself carries a premium. That premium is not about profit. It is about risk avoidance. Backwardation is not rare in commodities, but it is never benign. It appears when supply chains are stressed, when inventories are tight, or when participants fear disruption. It is the market's way of prioritizing access over efficiency. And when backwardation appears in a market that is heavily financialized, the consequences are amplified. Paper markets rely on time. They rely on the ability to defer obligations indefinitely. Backwardation attacks that assumption directly. This is why delivery demand terrifies bullion banks more than price volatility ever could. Price volatility can be hedged. Delivery demand must be met. Banks operate on balance sheets, not vaults. Vaults are the weakest link. They are finite. They are visible, and they are slow to replenish. Once metal leaves a vault, it does not behave like cash. It does not automatically return. It moves through refineries, manufacturers, and sovereign stockpiles. It gets consumed, transformed, or locked away. Each ounce that leaves reduces the buffer that keeps the system calm. Buffers are invisible until they are gone. Then everyone notices them at once. This is why inventory psychology matters more than inventory numbers. Official numbers can say one thing while behavior says another. If participants believe inventory is tight, they will behave as if it is tight. That behavior makes it tight. Belief creates reality in leverage systems. This is also where regional price dislocations become dangerous. When physical silver trades at a premium in one region relative to another, it creates arbitrage. Arbitrage requires metal. Paper does not move borders. Bars do. Once that arbitrage becomes attractive, the futures exchange stops being just a financial venue. It becomes a sourcing mechanism. Participants use it to obtain metal to satisfy off-exchange demand. This is when delivery pressure rises sharply. Every arbitrage trade is a silent drain on inventory. Each drain tightens conditions further. Each tightening increases fear. Fear increases urgency. Urgency increases backward rolling. This loop feeds on itself. Most people assume that if there were a serious supply issue, producers would simply increase output. That assumption ignores reality. Mining cannot respond quickly. Refining cannot scale instantly. New supply takes years, not weeks. Demand, on the other hand, can surge overnight when trust breaks. This asymmetry is why commodity squeezes are violent. Supply is rigid. Demand is elastic in time preference. When time preference collapses, price becomes the only release valve. This is why the idea that higher prices will automatically fix the problem is not of higher prices may eventually incentivize new supply, but not within the time frame that matters. In the meantime, higher prices simply ration existing supply. Rationing is not gentle. It is exclusionary. Now consider the March contract. March is not just another month. It is the center of gravity. It is where liquidity pools. It is where large players feel safest. It is where paper exposure concentrates. If stress appears in smaller months ahead of March, that is not comforting. It is alarming. It means pressure is building before the main event. Early stress is always worse than late stress because it removes optionality. If January and February are already tight, March has nowhere to offload pressure. The system loses flexibility. This is why professionals watch early months obsessively. They are the canaries. They feel stress first because they have less depth. When those canaries stop singing, smart money does not wait to see what happens next. They move. This movement is rarely dramatic on the surface. It is quiet. It shows up as subtle changes in positioning, unusual spread behavior, and unexpected delivery notices. To the untrained eye, nothing appears wrong. To the trained eye, everything is wrong. This is also where the public narrative becomes dangerous. Media explanations focus on macro themes because they are easy. Inflation, interest rates, currency weakness. These themes are broad and slow-moving. They cannot explain sudden changes in delivery behavior. Macro narratives explain trends. They do not explain urgency. Urgency is always micro. It lives in mechanics. It lives in deadlines. It lives in constraints. This is why watching the curve tells you more than watching commentators. Commentators talk about what already happened. Curves tell you what participants fear might happen next. Fear is forward-looking. Now imagine yourself sitting on the risk desk of a bullion bank. You are not emotional. You are not ideological. You are practical. You see delivery requests rising. You see participants choosing inconvenience. You see spreads behaving strangely. You see early months tightening. You do not panic publicly. You cannot. Panic creates liability. Instead, you attempt to manage behavior. You adjust spreads to encourage rolling forward. You offer incentives to delay delivery. You emphasize narratives that promote calm. You remind the market that inventory is sufficient. But these tools only work when trust still exists. Once participants believe delivery might become difficult, incentives lose power. No spread is attractive enough to compensate for fear of absence. No narrative is persuasive enough to override survival logic. At that point, every attempt to suppress urgency backfires. Lower prices encourage physical buying. Calming words contradict visible behavior. Incentives highlight desperation. This is the trap. The system is built to function under trust. When trust erodes, every stabilizing action accelerates instability. This is why physical shortages are so dangerous for paper markets. Paper markets cannot create physical supply. They can only redistribute belief. Once belief breaks, redistribution fails. This is also why price becomes violent. Violence in price is not emotional. It is mechanical. It is the system trying to reconcile obligations with reality. People often say markets are irrational during squeezes. That is incorrect. Markets are brutally rational. They do whatever is necessary to restore balance. Balance can be restored in only two ways. Either supply increases or demand is destroyed. When supply cannot increase quickly, demand must be rationed through price. That rationing does not happen smoothly. It happens in bursts. This is why squeezes feel chaotic. They are not linear. They overshoot, they undershoot, they gap. They reverse violently. But the underlying pressure remains until the constraint is resolved. Silver is particularly vulnerable to this dynamic because it straddles two worlds. It is both money and material. Investment demand and industrial demand collide in the same supply pool. When both demand streams activate simultaneously, the system strains quickly. Investors can wait. Manufacturers cannot. This distinction matters more than most people realize. Industrial buyers are not price sensitive in the same way investors are. They are access sensitive. They will buy through volatility because their costs of not buying are existential. Once industrial logic dominates, technical analysis loses relevance. Charts do not shut down factories. Supply interruptions do. This is the phase where markets stop behaving politely. And this is why backward rolling is not a curiosity. It is a confession. It is the market admitting that time has become dangerous. Everything that follows is consequence. When markets reach this stage, the most dangerous assumption is that authorities are unaware. In reality, authorities usually see the problem early. What they underestimate is how quickly confidence can collapse once behavior changes. Systems built on leverage and trust do not fail slowly once momentum shifts. They fail suddenly and often in ways that look irrational from the outside. The silver market is not isolated. It is woven into a much larger financial fabric. Futures contracts are collateral. They are hedges. They are balance sheet tools. When stress appears in silver, it does not stay contained. It bleeds into credit decisions, margin calculations, and liquidity planning. This is why delivery stress matters far beyond the metal itself. Consider how a bullion bank manages risk. It holds paper obligations on both sides. Long exposure here, short exposure there. As long as everything nets out in cash, the system functions smoothly. But delivery breaks netting. Physical metal cannot be netted the same way paper can. Once delivery enters the picture, positions that were previously offset suddenly become directional. A short is no longer just a number. It is a promise. Promises require fulfillment. This is where the difference between price risk and supply risk becomes critical. Price risk can be hedged indefinitely. Supply risk cannot. You either have the metal or you do not. When supply risk rises, risk models fail. Value at risk calculations do not account for no metal available. Stress tests assume markets clear. They do not model refusal. Refusal is not priced until it happens. This is why institutions fear delivery events. They force reality into spreadsheets that were never designed to handle it. Now add another layer. Silver is not stored in one place. It is fragmented across vaults, jurisdictions, and legal frameworks. Some metal is eligible. Some is registered. Some is pledged. Some is encumbered. Some cannot move without permission. On paper, inventory looks ample. In practice, availability is far narrower. This distinction matters enormously when delivery demand rises. You cannot deliver metal that is technically present but legally restricted. You cannot deliver metal that is already promised elsewhere. You cannot deliver metal that exists only as an accounting entry. This is where paper markets collide with physical constraints. When multiple parties believe they have claims on the same metal, everything functions smoothly as long as no one asks for it. The moment they do, conflict appears. This is why trust is the lubricant. Without trust, friction explodes. Now consider sovereign behavior. Governments do not think like traders. They think in terms of security, resilience, and strategic independence. Silver plays a role in defense, energy transition, and technology. It is not optional. When sovereign entities perceive instability in supply chains, they do not wait for confirmation. They secure material quietly. They do not announce it. They do not debate it. They act. Those actions are invisible until they are reflected in the market. Sovereign buying does not show up as speculative interest. It shows up as delivery requests, off-market transactions, and long-term withdrawal of inventory. Once withdrawn, that metal is effectively gone. This is why some shortages feel mysterious. The metal did not disappear. It was removed from circulation by actors who do not care about price discovery. Price discovery is a luxury of abundance. Another misconception is that shortages must be absolute to matter. That is false. Markets can function with thin inventories as long as participants believe replenishment is easy. Once that belief changes, thin inventories become intolerable. Tolerance collapses faster than supply. This is why confidence shocks are nonlinear. Small triggers produce outsized reactions. A single delivery failure, delay, or rumor can cascade, not because the event itself is large, but because it validates fear. Validation is fuel. Once fear is validated, everyone rushes to act before everyone else. This is the prisoner's dilemma of markets. Acting early is rational, acting late is fatal. This dynamic explains why squeezes feel unfair. Early actors secure access. Late actors pay any price or go without. The system does not distribute outcomes evenly. It rewards anticipation. Now focus on the role of margin. Futures markets rely on margin to control risk. When volatility rises, margin requirements rise. Higher margin forces weaker participants out. This mechanism is designed to stabilize markets. In physical stress events, it often does the opposite. Rising margin does not eliminate delivery demand. It concentrates it among those who can afford it. Those participants are usually the ones most capable of taking delivery. This concentration intensifies pressure. As speculative longs are flushed out, the remaining participants are increasingly physical-minded. Paper volume declines, but delivery intensity rises. This is why declining open interest during a squeeze is not bearish. It is structural. The market becomes smaller but more dangerous. This is also why sudden price drops during squeezes are deceptive. They look like relief. They are often clearing events that transfer exposure from weak hands to strong ones. Strong hands do not sell. They take delivery. Every shakeout tightens the noose. Now consider the role of exchange rules. Exchanges can raise margin, change delivery incentives, and adjust settlement mechanisms. These tools are powerful, but they are not omnipotent. Rules cannot create metal. In extreme cases, exchanges can encourage cash settlement. Cash settlement is presented as efficiency. In reality, it is a confession. Cash settlement means the system cannot deliver what it promised. It replaces obligation with compensation. This may resolve contracts, but it destroys credibility. Once cash settlement becomes expected, futures lose their function as hedging tools for physical users. Why hedge with a contract that may not deliver? This is the ultimate risk for any commodity exchange. Loss of relevance. Markets survive on credibility. Once credibility is questioned, participation changes permanently. This is why exchanges fight so hard to preserve the appearance of normalcy. Appearances buy time. Time is everything. But time is exactly what backward rolling rejects. The moment participants refuse to wait, the system loses its primary buffer. Now look at price behavior through this lens. Rapid advances followed by sharp pullbacks are not signs of distribution. They are signs of stress. The market is oscillating between fear and forced liquidation. Each oscillation ratchets tension higher. The public often misreads this as manipulation. Manipulation implies control. What you are seeing is loss of control. No one wants price to behave violently. Violence increases risk for everyone. Violence is tolerated only when there is no alternative. This is why squeezes feel disorderly. Order has already failed. Another layer to consider is the role of derivatives beyond futures. Options, swaps, structured products all reference the same underlying reality. When futures markets strain, derivatives amplify the effect. Option writers face gamma risk, swaps face basis risk, structured products face correlation breakdowns. All of these risks assume liquid futures markets. When liquidity thins and delivery pressure rises, assumptions break. This is how localized stress becomes systemic. Silver may appear small relative to global markets, but its role as a bellwether matters. Stress in silver often precedes stress elsewhere because silver sits at the intersection of money and industry. When silver breaks, it signals deeper fractures. Historically, silver has always moved first, not because it is more important, but because it is less controlled. Gold is managed carefully. Silver is tolerated until it cannot be. This tolerance makes silver dangerous. Now consider psychology. Most participants are anchored to past behavior. They assume markets will behave as they always have. Anchoring delays response. Those who break anchor early gain advantage. Those who wait for confirmation pay for it. This is why the majority always misses the inflection. Inflections are uncomfortable. They require acting without consensus. Consensus arrives after opportunity is gone. This is the brutal truth of markets. Right now, silver is in an inflection phase. Behavior has changed. Structure is shifting. Narratives have not caught up. This lag creates confusion. Confusion creates complacency. Complacency is the final ingredient. When complacency meets structural stress, outcomes accelerate. This is not about predicting a date or a price. It is about understanding a process. The process has begun. Once processes like this start, they do not reverse easily. Trust does not return on command. It returns slowly after damage is absorbed. The damage phase is always fast. This is why warnings feel early until they feel late. Backward rolling was the warning. Delivery pressure is the confirmation. Price will be the aftermath. At this point in the cycle, the conversation usually turns toward blame. People look for villains, conspiracies, or single causes that can explain what is happening. This instinct is natural, but it is also misleading. Structural failures are not caused by bad actors alone. They are caused by systems that depend too heavily on assumptions that eventually stop being true. The silver market's central assumption has always been that paper claims can expand far beyond physical supply without consequence because delivery will remain rare. That assumption worked for decades because confidence was stable and physical demand remained manageable. What has changed is not morality or regulation. What has changed is stress. Stress exposes hidden fragilities. One of the most fragile assumptions is that liquidity equals safety. In normal conditions, deep liquidity allows participants to enter and exit positions with minimal friction. It creates the illusion of control. But liquidity is only protective when it is backed by confidence. When confidence fades, liquidity can evaporate instantly. This is why flash events happen. Everyone believes they can exit until everyone tries to exit at once. In silver, the exit is not always a sale. Sometimes the exit is delivery. Delivery is the most extreme form of exit because it removes metal from the system permanently. Unlike selling a contract, delivery does not transfer risk to another participant. It eliminates the contract altogether. Every delivery tightens conditions for everyone else. This is why the system discourages delivery subtly. It makes it inconvenient. It makes it expensive. It makes it operationally complex. These frictions exist for a reason. When participants willingly overcome those frictions, it signals something profound. Another assumption that breaks during these phases is that markets are self-correcting. Self-correction requires elasticity on both sides. Prices rise, demand falls, supply rises. That loop restores balance. Silver lacks that symmetry. Demand does not fall quickly because much of it is inelastic. Supply does not rise quickly because it is constrained by geology, permitting, and capital cycles. Without symmetry, correction becomes violent. This is also why policy tools have limited effect. Raising interest rates, job owning, or adjusting regulations may influence speculative behavior, but they do not create ounces. Physical markets respond to availability, not policy statements. This is where many analysts get trapped. They apply financial logic to material problems. That mismatch leads to false confidence. Material problems resolve materially. Another layer of fragility lies in rehypothecation. The same silver bar can support multiple claims across different jurisdictions and contracts. This works as long as claims are not exercised simultaneously. When they are, the system must choose winners and losers. Systems are not designed to choose. They are designed to process. When forced to choose, systems fracture. This is why delivery pressure is feared. It forces resolution. Resolution exposes inequality of claims. Once exposed, trust collapses rapidly. Now think about timing. Timing matters less than sequence. People obsess over when prices will spike. Professionals focus on what happens first. What happened first in this cycle was behavioral. Participants changed how they treated time. That change cascades. Once time preference collapses, everything speeds up. Decision cycles shorten. Risk tolerance shrinks. Hedging horizons compress. This compression creates volatility. Volatility then feeds margin calls, which force liquidation, which feeds more volatility. The system oscillates violently as it searches for equilibrium. Equilibrium will be found only when either demand is destroyed or supply is revealed to be sufficient. Revelation can come in two forms. Either new metal appears or official mechanisms admit constraints. Both are disruptive. If new metal appears, prices may stabilize but credibility is still damaged. If constraints are admitted, credibility is destroyed. There is no painless outcome. This is why late-stage commodity squeezes feel grim. They lack celebratory energy. They are driven by necessity, not optimism. People do not cheer for access, they fear losing it. This fear explains why narratives lag. Narratives require optimism. Fear operates without narrative. Now consider retail participation. Retail arrives late because retail requires story. Story requires price confirmation. By the time retail becomes active, professionals are already positioned. This is why retail often becomes exit liquidity and squeezes. Not because retail is foolish, but because retail reacts to visible signals. Structural signals are invisible to most. This invisibility creates moral outrage after the fact. People feel the game was rigged. In reality, the game rewards those who watch behavior instead of price. This distinction matters because it determines how you interpret volatility. If you think volatility is manipulation, you wait for fairness. If you think volatility is resolution, you act accordingly. Waiting for fairness is expensive. Now imagine the system reaching a point where delivery obligations exceed comfortable inventory. Exchanges face a choice. They can allow price to rise to whatever level is necessary to ration demand, or they can intervene administratively. Both choices carry risk. Allowing price to rise exposes leverage and destabilizes linked markets. Intervening exposes fragility and destroys trust. Historically, systems choose intervention. Intervention rarely solves the underlying problem. It postpones it. Postponement often makes the eventual resolution worse. This is the paradox of control. Attempts to control outcomes reduce resilience. Resilient systems allow stress to clear early. Silver has not been allowed to clear freely for a long time. This is why pressure has accumulated. Now think about what happens when price moves beyond psychological thresholds. These thresholds are not technical, they are mental. At certain levels, behavior changes abruptly. Holders refuse to sell. Users panic buy. Hedgers scramble. These shifts are discontinuous. This is why price jumps feel sudden. They are the result of many small decisions crossing a collective threshold. The public sees the jump. Professionals saw the tension long before. This gap in perception fuels disbelief.